Why does it happen that whenever we draw a Fibonacci retracement during a pullback, the price either ignores the levels or suddenly reverses against us? If you've experienced this, you're not the only one. The problem is not Fibonacci. The problem is where and how you are using it. In smart money trading, institutions don't blindly respect retail levels. They hunt liquidity first. Most traders believe that a pullback is just a liquidity grab. This is what we call an institutional trap. In this video, I will show you how to avoid this mistake and use Fibonacci the smart way. And at the end, we will discuss the Fibonacci retracement strategy that you can use in the continuation trend, as well as during the reversal trend. Before we start the video, if you're interested in topics like this, do like this video and subscribe to our channel to stay updated on our upcoming videos. Let's begin the video. These are the topics that you'll learn through this video. First, let's begin with, what is a pullback? A pullback is a short-term pause in the market's current trend. In an uptrend, where the price is making higher highs and higher lows, the pullback happens when price goes below its previous higher high. In a downtrend, a pullback occurs when the price goes above its previous lower high. The market basically runs in three phases: the uptrend phase, downtrend phase, and sideways. Understanding these three phases is crucial, as each trading strategy works differently depending on the market structure. The uptrend is when the price is forming higher highs and higher lows. The sideways phase is when the price is moving in a range. And the market is said to be in a downtrend when the price is forming lower highs and lower lows. A pullback matters a lot as it gives better entry points and increases the risk-reward ratio. Now the big question is, when a pullback happens, which point should we enter to get a nice risk-to-reward ratio? This is where the Fibonacci retracement tool helps us. The Fibonacci retracement levels help us to know the exact point from which we can enter long to get a nice risk-reward ratio. The market is currently in an uptrend phase, but it is now starting to make a pullback. And thus, we will draw the Fibonacci retracement tool from this point until this higher high. We have taken two Fibonacci levels, which are 50% and 61.8%, which is also called the golden zone. Did you notice anything strange in this example? Each and every trader does the same thing as we did here. Drawing these two levels, and then once the price reaches this point, we enter long, hoping that the price will go up after this move. The stop loss of the majority ones would be placed at or a little below this 61.8% level. This is where smart money comes into play. Smart money will push the price below the 61.8% level, which will hit their stop loss and remove them from the market. The smart money has now got sellers from whom they will buy the stock, and they have also obtained it at a lower price. This indicates that there was a heavy buying at this point, as the price goes up. To prevent yourself from getting into this trap, you must wait for confirmation from the market side. Like here in this example, we see the price making lower highs and lower lows, suggesting that the price is in a downtrend phase. The price has started making a pullback, and hence, we will draw a Fibonacci retracement from this high till this low. We have taken three levels for this example, which are 50%, 61.8%, and 78.6%. The price has already reached the 50% fib level, and then gradually, price reaches the 61.8% level. Now between these two levels is where most of the traders are initiating a short trade. But we recommend you not to do so and instead wait for the market to form at least 4 to 5 red candles which show buyer strength. After forming 3 red candles, price makes 2 green bullish candles, which indicates that buyers are taking control over the market. Confirmation is highly necessary while initiating a trade. Let's see what happens next. Price moves up a little until this 78.6% fib level and then forms multiple bearish candles with a large body. This move by the market removed a lot of early buyers, but smart money got what they wanted, a lot of buy orders. The price continues to go down after this level. But sometimes it happens that waiting too long ends up with us not initiating any trades. There's a trick to resolve this too, along with not getting into the smart money trap. Let's learn it from another example. So, we could see an uptrend here. The price here has made a pullback, which is why we will use the Fibonacci retracement tool to draw it from this low to this high. price reaches the golden level, which is 61.8% level. After reaching this point, the price starts to make some green candles, indicating that buyers have stepped in. But this is not a confirmation. Taking a trade from this point would be a risky move. But if we wait even longer, then the price might go above this level instead of going below. So, in such a situation, we will wait for one more candle in our favor, which is bullish in this case. Price creates a green candle with a slightly bigger body than the previous one. Now, we will initiate our trade from this level, and we will place our stop loss a little below the 78.6% level, so that even if the price goes a little below for a liquidity hunt, then it won't hunt our stop loss. The risk-to-reward ratio in this trade is placed at 2.5:1 ratio. The price does a liquidity hunt with this candle and then gradually continues its trend. And finally, it hit our target point, which gave us significant profits. Now, sometimes it happens that the price does not respect the Fibonacci levels. Like in this case, price makes a pullback. So, we will draw Fibonacci levels from this low to this high. The price has reached the 50% level, but it didn't respect it and instead went below it. Now the next hope is at the 61.8% level. The price didn't respect this level either, and instead continues going downwards. Traders who placed their trades at any of these levels would have ended up losing money. And then, they will blame the Fibonacci tool for not working correctly. But the real problem here is that when we zoom out a little, then we can clearly see that the overall trend of the market was bearish, and we were looking for buy setups instead of sell setups. Multi-time frame analysis must be done before plotting the Fibonacci retracement levels on the chart. The first thing that we need to check before plotting the Fibonacci retracement levels is the overall trend of the market. Because if you are trading against the trend, you may suffer heavy losses. And as the saying goes, the trend is your friend until it bends. Let's move on to the next topic, which is point of interest. The point of interest is a key price zone where institutions are most likely to enter or exit the market. Traders wait for the price to return to these areas, such as order blocks or fair value gaps, to find high-probability trade setups. When we plot Fibonacci retracement levels on our chart, we can see multiple levels. And knowing the exact one that the market will respect is a difficult task, every time the price doesn't respect the golden level. Sometimes, it may also respect the 50% or 78.6% level. Now this is where the POIs help us. When we use the POI zones in confluence with Fibonacci levels, the probability of a win trade increases. This is what our second strategy is all about. Let us now begin with our first strategy. In this strategy, we will use the confluence of multi-time frame analysis and Fibonacci retracement levels. Let's learn it through an example. Here we have the chart of gold on 4-hour time frame. Price is forming higher highs and higher lows, which suggests that the market is in an uptrend, and hence we will look out for buying opportunities. On the higher time frame too, we can see that the price is in an uptrend, and hence the overall trend is uptrend. We cannot buy from any random point as it might end up losing our money, and hence we will wait for a pullback to occur, so that we can buy it at a low price and then sell it at a higher price. The price has started making a pullback, so we will plot the Fibonacci retracement tool from this point until this high. We will only take these 3 levels as there are higher chances of the market respecting them. The price has reached the 50% level, but it is still making red candles, indicating that it will still go downwards. At 61.8% level, the price is making doji candles indicating indecision into the market. A green candle, which is why dozens of traders will go long, as they believe that the price will go upwards. But we won't do so as this area is where a lot of liquidity is gathered, and hence, we will wait for a little more confirmation. By doing so, we are taking a risk of getting a lower risk-to-reward ratio, but it will save us from the liquidity hunt. The price went a little below, which removed a lot of early buyers from the market. Then, price forms 2 bullish candles with a bigger bodies, which is our confirmation that the buyers stepped into the market. We will initiate our trade from this point. In a situation like this, you must place your stop loss below the 78.6% level in order to prevent the stop loss hunt. The risk-to-reward ratio is placed at 3, is to 1. The price continues going upwards, and it finally hits our target. Now that we have learned the continuation trend strategy, we will move on to the reversal trend strategy. So here we have a chart of silver on 4-hour time frame. The price is currently making lower highs and lower lows, indicating a downtrend. But when we zoom out a little, we can see that a demand zone has formed here, and the price is coming at this level. And that's why the price is making lower highs and lower lows. Now we will switch over to the lower time frame for confirmation and entry. The price has finally reached the demand zone, and after reaching here, it has started making bullish candles. We can see that price is making a bullish move and then forming a pullback, which is why we will plot the Fibonacci retracement tool from this point until this high. The price has already reached the 50% level, but it is still going downwards. Let's see what happens at the 61.8% level. At the 61.8% level, the price is making small indecisive candles, indicating that neither sellers nor buyers are dominant in the market. And thus, we will wait for the price to form a few more candles in order to know the direction in which the price will head further. The price makes multiple bullish candles, which indicates that buyers are in control of the market. Thus, we will enter from this point. We will place the stop loss a little below this 78.6% level in order to prevent the stop loss hunt. The price has reached our target point, which helped us make significant profits from this trade. The proper placement of stop loss is a must. Now that we have learned our first strategy, let's move on to our second strategy. In this strategy, we will use the confluence of point of interest and Fibonacci retracement levels. Let us learn it through an example. So here we have a chart where the price is making lower highs and lower lows, which indicates that the price is in a downtrend phase. And thus, we will look out for sell opportunities. We will wait for a pullback to occur into the chart, as then only we can short the market at a higher price. The price has finally made a pullback, and thus we will plot the Fibonacci retracement levels from this high till this low. We have taken 3 fib levels as usual. Now let's draw the POIs on this chart. So here we have 2 point of interest zones on this chart. The first one is this resistance zone, and the second one is this flip zone. There are higher chances of this flip zone getting respected, but let's see how the market reacts. This flip zone is formed between the 61.8% level and 50% levels, which is also called the golden level. The price is making multiple doji candles after reaching this level. This shows that the buyers are getting weaker, and currently neither buyers nor sellers are dominant into the market. And that's why we will wait for a few more candles to form in order to determine the direction in which the price will move forward. The price has made a few bearish candles, which indicates that the sellers are taking control over the market. And therefore, we will initiate our sell trade from this point. The stop loss will be placed at the 78.6% level. And the risk-to-reward ratio of this trade is kept at 2.5:1 ratio. The price continues going downwards towards our target point. This downward move helped us earn significant profits from this trade. This brings us to the end of this video. But before we end this, if you liked our content, then be sure to like this video, and don't forget to subscribe to our channel to never miss out any of our upcoming videos.